Well, Contessa, Brewer, Bill Griffith, Leslie Picker, all with me for Rapid Fire, guys. And the market is taking this relatively in stride.
That's what I find very interesting.
0.3% gain so far for the Dow and S&P. Still, the Nasdaq still up 0.7%. This was not anticipated. This is a big deal to extend it to the rest of the import.
This is exactly the kind of headline that would send the market lower,
Spiraling
would send the market lower,
yeah.
In any other time. I mean, we're still in the sort of the Fed afterglow right now, but I'm finding it very interesting that we are not dropping appreciably with this kind of a headline.
But I think that
I mean, we are up only 50 points now. We were up more than 100,
yeah.
so it is coming off. But, I mean, this is the kind of thing that would send it down 100 points immediately.
Absolutely.
Right? But I think part of this is that the expectation for a trade deal had been greatly diminished before this ever went in, and that there are companies who have now formulated strategies for tariffs for the next half a year or beyond because the uncertainty is certain.
But you wonder, because the companies that were already affected were ones that they had first been hit by 10%, then they'd been hit by 25%. Now you're talking about a whole set of companies who maybe some for the first time are going, oh, here we go. Now we have to come up with a plan,
I just don't think there was a lot of optimism that they were going to be able to come up with a deal to avoid it.
And I think...
Go ahead, Leslie.
When you hear that tweet, there's not that much in the way of details other than 10% September 1st.
Right.
So I think oftentimes the market, as it relates to the trade deal these days, it's kind of wait and see and wait for more information, wait to see what solidifies. There's still a month to go. Maybe something can happen.
Yeah. And as Eamon pointed out, 10% is less than 25%.
And I was premature. We are heading into negative territory right now.
The president himself, by the way, downplaying this move. In his tweet, he called this a small additional tariff of 10%. Remember, it was the 25% level that really kind of spiraled the markets earlier this year on the initial round. The 10% had been in place for almost a year now.
As we've been saying, the market had already priced in disappointment, or I should say they'd already priced in the possibility that we were going to get something down the road. What would disappoint the market is if you saw a step backwards, and this is a step backwards.
Absolutely.
Obviously, Shanghai didn't go well this week.
Right.
They called it constructive, but that's trade talk.
That's what they always call it when it's not.
Nothing happened, right? And they wanted something to happen.
The Nasdaq hanging on to about 0.3% gain. We're going to have much more on this. Yeah. Let's hit a couple of related stories, though. We have Qualcomm already was falling today after missing the street's expectations on revenue and guidance. The CEO, Steve Mollenkopf, was pointing the finger at Huawei, saying the Chinese tech firm's growing smartphone share in China would create headwinds for them the next couple quarters. Also talking about U.S. consumers, guys, being in pause mode ahead of the 5G launch.
This is a kitchen sink full of excuses from Qualcomm, as far as I can tell. The trade issues, the headwinds there. The reduced royalty payments from Huawei because they're in a patent dispute with them like they have been with Apple for all these years. And, oh, by the way, that transition from 4G to 5G means lower demand for 4G products right now. I mean, what am I missing? Was the weather bad, too? I don't know.
Well, that's why, at least according to a Goldman Sachs report, in the first quarter, Qualcomm on an absolute value basis was the most shorted stock out there by hedge funds. It's because you see all of this overhang with regard to litigation, with regard to supply chain, and then, of course, throw some kind of demand aspects around 5G, and you've got a whole cornucopia of issues.
Those shares had roared, especially when they got a positive settlement with Apple. So perhaps, priced it too much to perfection.
Although the CEO also said that they're expecting these headwinds, especially in China, for the next 2 fiscal quarters. It makes me wonder what they see beyond 2 fiscal quarters that might change those conditions in China.
And he talks about the sales of the Huawei smartphones. I mean, this is where you start to look at the nationalization, if you will, taking place, right? When China starts to say Chinese products are going to win in this market, when the U.S. starts to say U.S. products are going to win in our markets. I mean, we talk about Macau, some of the numbers out there, and the company's trying to figure out, hey, do we still have a long-term business here or not?
And what's really interesting is the number of companies that do not want to talk about the trade uncertainty related to their business, and those casinos in Macau are among them, because not only do they have to deal with what it does to the Chinese economy, who it affects in terms of the gamblers coming in, but they don't want to undermine the negotiations for concession renewal either.
I want to point out,
way,
is that what you were going to point out? Yes, that's what I was going to say.
189 on the 10-year note?
We are sub 1.9%. We started out this morning at 2.05% or thereabouts.
Dropped to 95, which was going to be a low we hadn't seen in months, but now we're at 189.
And as the strategists were saying, watch the 195 level. If we break below that, well, all it took was this news, which you can see on your screens there, that the president said an additional 10% tariff on China on those additional $300 billion worth of goods will be going into effect on September 1. Now, equities not only came off their highs, those markets have turned lower now. But Bill, you're absolutely right. Look, that is a massive move.
That's huge.
In fixing up for what's already been a massive move this year.
Fit right now.
That's right. Tear up the charts, get out the new ones. If there's a silver lining, I guess it's that mortgages in this country are going to get even a little bit
like the housing
cheaper.
market needs the help.
Yeah, exactly. A couple of other things to just mention here, and then we'll continue to kind of roll the tariff news into it. Activist hedge funds have caused a lot of headaches for corporate boards. They've pushed out board members. They're agitating for changes to cut costs, return money to shareholders. Institutional investors in these funds are doing some agitating of their own. They're pushing activists for increased transparency and lower fees. And Leslie, this had been a great year for hedge funds generally. I mean, obviously, it's been a great year for the stock market. How much pressure is now coming to bear on some of these funds?
A great year for hedge funds, specifically those that invest in equities, and activism tends to be the most concentrated strategy that invests in equity, so primed to benefit from this. But what you're talking about is a Reuters article that came out this week that looked at these special purpose vehicles, where they're essentially single stock funds that allow managers of these funds, well-known names, Nelson Peltz, Corvex is one of them, Keith Meister at Corvex, Dan Plans at Vache Capital. They basically are able to invest in one stock idea, share that with LPs. Oftentimes they're existing LPs in their other fund. And then that way they're able to have kind of more of a give and take with their LPs in order to make changes at that company and get their LPs on board before they do things. That said, it's not all, a free lunch for these LPs either. They're locked in. They're still paying fees. Oftentimes with these special purpose vehicles, they're super liquid stocks like Procter & Gamble. Remember that one with Nelson Peltz? That was based on an SPV. And the investors in that SPV were locked in for quite some time, usually 2 to 3 years.
So they're saying you have to play by the same rules you make everyone else play by.
Exactly.
In a nutshell.
You may pay slightly lower fees, and you might know a little bit more about the idea before it gets into it, but you're still locked up, and you're still paying fees at the end of the day.
One more headline of note to mention today, and this is kind of an interesting one. J.P. Morgan has hired Persado, which is a firm that creates artificial intelligence-generated ads, after a pilot promotion created by a computer received 2 to 5 times the response of ones created by human copywriters. Let's quickly show you a couple of these ads that we're talking about. The machine-created ad you'll see on the right hand of your screen. It generated nearly 5 times the unique clicks of the human-written one on the left. So on the right-hand side of the screen, this is by the machine. It says, regarding your card. It seems like it'd be totally boring. The one on the left, the humans wrote. It says, hurry, ends December 31. Well, you can see the one on the right, guys, revenue, AI generated unique clicks was 24%. It did much better. What does it mean that the machines can do this better than
Persado, in fact,
can?
goes even further, and it says that it has a 41% conversion uplift here. More than 250 top companies have signed on to this. Expedia, Staples, StubHub, among others. But here's the thing. One, if your computer writes better copy, it means that our advertising departments across this country are not doing a very good job teaching how to write creative, compelling copy.
Yes.
2, the machines will take over. Once they realize that the humans are inefficient and these are algorithms designed to destroy inefficiencies, there we go. What's the biggest inefficiency in copywriting? Humans.
We will leave it on that uplifting note and bring Patrick Chovanec in to talk with us about this news that you see on your screen there that just broke in the last 10 minutes or so. President Trump saying an additional 10% tariff on China will go into effect on September 1 on the remaining $300 billion worth of goods that had not yet been tariffed. The markets, with the exception of the NASDAQ, have turned negative on this. The Dow had been up more than 300 points at the highs. Patrick, we were just speaking at the beginning of the hour about whether a move like this was likely. What do you make of it?
Well, we were, and I was saying that the good news is that there wasn't an escalation, and that the president held off in large part because of the pushback from business and from the markets whenever he proposed actually doing something like this.
Right.
So this is something that markets and the businesses across the United States have been worried about happening for some time.
So the interesting thing is the president even describes this as a, quote, small additional tariff of 10%. When the first 10% tariff went in about a year ago, there was not a massive response, Patrick. It was when that tariff was ratcheted up to 25% that we really saw the market reaction. We're seeing a market reaction today, but can the president be right that this is just a small move? Can the companies absorb this and shake it off, or are we going to see another spiraling of uncertainty show up in the U.S. data?
No, it's not a small move, and the reason why is because the initial tariffs were targeted to goods that would have a minimal impact on the U.S. economy, that were easily replaceable, easily sourced from elsewhere. When you broaden that out to almost all Chinese goods, then the impact on the consumer, even if it's just 10% instead of 25%, becomes a lot harder for companies to avoid. They either have to absorb it or they have to pass it on. And so, yes, it's not as bad as there being a 25% tariff, as he sometimes proposed, but it's something that would definitely hit a broader range of industries and have a bigger economic impact than those narrower tariffs.
Yeah, and Patrick, stay with us if you will. Want to get back to Eamon Javers, who's at the White House, with some more news, Eamon, on how we got to this point this afternoon.
Yeah, I've just been talking to a White House official here inside the West Wing, getting some context on how the day has unfolded for the president. You remember that those talks broke up in Shanghai yesterday. The president had a meeting, I'm told, by a White House official at 11:30 this morning with Treasury Secretary Mnuchin and Robert Lighthizer, the U.S. Trade Representative, to discuss how the talks went. Obviously, this tweet comes after that meeting, so you can presume that the report to the president was that the talks did not go quite as well as hoped, and they decided that they needed some additional stiffening of the spine here on the part of the U.S. side to show the Chinese that they do mean business going into that September negotiating session. Interesting, though, as you've been flagging, that this is just a 10% tariff as opposed to the 25% number that we've been talking about for the past number of months. It may be, and we're now moving into the realm of speculation on my part here, it may be that the president considered a range of tariff rates and settled on 10% as not as fully provocative as a 25% tariff would be, but nonetheless intending to send a message here to the Chinese side that they are serious about these negotiations, and this gives a little bit more edge or bite to those negotiations that are coming up in September here in Washington, Kelly.
It certainly does. Eamon, also stay with us, if you will. Rick Santelli is monitoring the action we were just discussing in bond yields and other asset classes in reaction to this. Rick, I mean, if the president wanted a weaker dollar, he finally got it.
Well, I'll tell you what, Kelly, everything's moved a whole lot more actually than the dollar. It's just a bit below unchanged, but point taken. The real brunt of this actually has been taken by two-year note yields. They were down 16 basis points, 1.6 at 171. Now they're at 173, only 14 basis points. The irony here is we're actually getting some curve steepening back because this latest drop in 2 years really was much bigger than the long end. Looking at intraday 10, it was down 13 basis points at 187, so it's coming back just a little bit. But as you see, going back to November of 16, Kelly, we have room before we change that November comp, because back in November 16, we ended up in the 170s, and 30-year bonds are down 9, now down 8, going back to October of 2016. You know, we were talking earlier about how 195 was very significant. Boy, did you ever see it. The minute it traded through, lots of stops, a lot of activity occurred, but the yield curve has steepened just a little bit. Right now it's sitting around 16, 17. Yesterday at its worst levels it was around 12. Last night and this morning hovering at 14. So we want to keep an eye on all the moving parts. And yes, the dollar's down by 1/10 of a cent, but it's down to levels that are still up on the week.
It's just astonishing. 1.87%. I want to make sure everybody caught that. That's the low in the 10-year U.S. Treasury yield moments ago.
Let's recall yesterday's news conference with Jerome Powell, where trade came up, and he said trade is unusual. They're sort of taking it as it comes, finding their way through this process, and now with an additional 10%. The Fed meets again next month.
Yes, they do.
And you wonder what the possibilities are now.
You said it well earlier. I mean, if this hadn't come in the sort of halo effect market reaction today from the Fed yesterday, you wonder how much worse the thud would have been felt. Look at the reversal now. The Dow's down 131 points. That's an almost 500-point swing from the highs earlier today. Bob Bassani has more. He's on the floor of the NYSE. Bob?
And we had such a nice little narrative going here this morning. Kelly, the ISM was a little weaker than expected, but still showing expansion. Everyone said, hey, this is perfect because this increases the chances the Fed might cut. And we were up nicely, 25 basis points, 25 points in the S&P. And then we get this. And the problem I think the market has is August is a really tough backdrop, a big setup here. We know it's a weak month, traditionally the weakest month. September's not very good either. We know stocks are pricey. The S&P is up 20%. Earnings are flat. That means that the market's pricey right now, so the risk is to the downside. We know there's a lot of uncertainty on the global economy, independent of tariffs and trade already. We've seen some weak numbers out of Europe in the last couple of days. And finally, we have Mr. Powell saying, well, we're not sure whether there's going to be additional rate cuts or not. So the backdrop is very, very tough for the markets overall here. If you take a look at the standard trade names, we saw the usual mess occurred just about 15 minutes ago. Nike is a good example of a global trade stock here. Nike dropped more than $1. If you put that up, that was in the 80s. There you go, straight down. Right there. And the other usual suspects, any of the global industrials, Caterpillar, I saw just go by a moment ago, was 128. I think it was 132 before. There it is, 128. It was 132, 33 before that. So you can see the usual suspects all down about 3% on average. Kelly?
All right, Bob, thank you very much. And Mr. Santelli will give you the final word on all these moves.
Fed fund futures are roaring to the upside. Eurodollar futures are roaring to the upside. What does that mean in English? The more they rally, the more easing the market sees ahead. So it's something to pay attention to. Is the response to tariffs is swift in those markets.
What's it say on September, Rick?
Oh, I don't look at percentages, but September contract right now is up about 4 ticks. And I look at more of the direction than the static snapshot of percentages.
Yeah, it's telling you that's how you put the whole landscape together.
It was 74% yesterday that they do a 25 basis point cut in September. Now it's going up again.
Even higher from there. Guys, thank you all. Really appreciate it. Contessa, Bill, and Leslie.